At 9:32 a.m., the price jumps 40 cents in 3 seconds. Then it snaps right back. You stare at the screen. Who hit the gas? It feels random. It isn't. Sometimes the move happens because the middleman between buyers and sellers steps back. Price then has to leap to find the next deal. And sometimes that jump is exactly what flushes you into a bad entry, buying or selling at a terrible price. So what are they actually doing? Two people want the same concert ticket. One will pay $80. The other wants at least $92. No deal happens yet. Then a reseller steps in. He says, "I'll take the risk. I'll hold the ticket for a minute." Now the trade can happen. A middleman is bridging the gap. That is the basic job of a market maker, a firm that always offers to buy and sell. Think of him as the store clerk between impatient shoppers. He stands between buyers and sellers. He offers one price to the person who wants in now. He offers another to the person who wants out now. On a calm day, that feels invisible. Your screen looks smooth. Price moves a little, pauses, then moves again. But now picture a thin ladder of prices on your screen. There are gaps. Not many shares sit at each level. It's 9:31 a.m. Coffee's still hot. A headline hits. Suddenly a crowd rushes the same way. The middleman now has a problem. If he keeps offering the same price, he can get run over. So he backs away, or he widens the spread, the gap between the bid price and the ask price. When that happens, price may jump to the next level where someone will actually trade. That jump can feel like magic. It isn't magic. It's inventory control. Think about an airport water bottle. During a snowstorm, the price is never cheapest when everyone is desperate. Same product, different pressure. The middleman changes the terms because demand is suddenly one-sided. Markets do a faster version of that. Sometimes the middleman steps back. Sometimes he tests higher prices to find willing sellers. Sometimes he drops price hard to find willing buyers. The move looks dramatic, but the goal is simple. Match people who want opposite things. What's interesting, this part hurts beginners. You often see the jump after the easy price is already gone. You're not reacting to the cause. You're reacting to the scramble that came after. So the middleman can step back, widen the gap, and force price to search. The next question is obvious. How do you stop chasing that search at the worst possible moment? Your screen lights up green. A candle, the little bar that shows how price moved, shoots higher in 3 seconds. You feel that little panic hit. If you don't click now, you'll miss it. That feeling is the trap. Sometimes price races into an obvious area where many traders placed a stop loss, a preset price where you automatically get out of a losing trade. The move can look strong, but strong and safe are not the same thing. A fast jump often means the easy orders were already taken. The middleman stepped back. Now price is searching for whoever will trade next. So your job is not to be fast. Your job is to slow the moment down. Pull your hand off the mouse, literally. Then write 3 things. First, what would prove this move is failing? Name the price. Second, how much money is at risk if you're wrong? That is your position sizing. How much money you put into any single trade. Third, are you reacting to your plan or reacting to motion? If you can't answer those fast, you're not reading the move. The move is reading you. Here's the part beginners miss. At 9:41 a.m., the candle that looks strongest is often feeding on FOMO, fear of missing out, buying late because everyone else is. The jump pulls in chasers, hits clustered stops, then runs out of fuel. That's why price so often spikes, stalls, and snaps back. So don't chase the jump. Make it prove itself after the burst. And once you do that, one pattern starts showing up everywhere. The chaser and the waiter get the same signal, but only one of them gets trapped. Still with me? Here's the part that trips up most traders. 2 people see the same 9:41 a.m. price burst. The one who clicks faster often loses more. On the left, you have the chaser. Price shoots up 3 candles in a row. The app flashes green, the notification buzzes, your chest tightens. You think, it's moving now. If I wait, I miss it. So you jump right into the burst. What are you really doing? You're paying the most emotional price on the screen. You're not reacting to proof, you're reacting to speed. On the right, you have the waiter. Same chart, same burst, same fear. But the waiter does one annoying thing the chaser hates. Nothing. He watches the jump hit the obvious area where late traders pile in and panicked traders get forced out. Then he waits to see what happens next. Does price keep pushing? Or does it poke above that area, stall, and fall back? That tiny pause matters more than the jump. The chaser treats motion like evidence, the waiter treats reaction like evidence. That's the whole split. In poker, a card game where players bet, this is like seeing someone push chips in fast and assuming strength. New players react to the noise. Better players wait for the full story. Speed feels convincing, but speed is not the same as truth. Trading works the same way. A fast move can be real. It can also be a stop run, where a burst tags a bunch of stop losses, a preset price where you automatically exit a losing trade and then runs out of fuel. Chase that burst and you become the extra fuel. The waiter isn't smarter. He's just asking a better question. Not, is it moving, but what happens after the obvious crowd reacts. That keeps you out of emotional trading, making trades driven by fear, excitement, or ego, not a plan. It also helps protect your capital, your trading money, because every bad entry costs money and confidence. So when the candle rips, the real test is simple. Are you reacting to the first shove, or waiting for the answer after the shove? Once you see that difference, the next step gets specific. 3 questions can tell you, in about 10 seconds, whether this move deserves your click. It's the same edge a poker player has at the table, the discipline to fold a tempting hand when the numbers turn, and the nerve not to tilt after one bad beat. There it goes. At 9:41 a.m., a tall green candle shoots above the morning range. Your phone buzzes. The chart looks like it finally picked a direction. You've seen this move before. Price was stuck for 20 minutes. Then it punches through the top. Traders call that a breakout, price punching through a level it had been stuck below. Now watch 2 people make 2 very different decisions. The first person sees the candle rip and clicks fast. No pause, no note, just pure reaction. His whole thesis, your specific reason for taking the trade, is basically, it's moving, so it should keep moving. That works sometimes. Which is why this trap keeps fooling people. For about 30 seconds, it even looks smart. Price pushes a little higher. More late chasers pile in. People who bet the other way panic and get forced out. That extra scramble can stretch the move even more. Then something changes. The next candle stops climbing. Not crashing yet. Just stalling. The price tags above are thinner now. The easy fuel is gone. A few seconds later, the candle snaps back under the breakout level. Then it drops back into the old range, like the whole move was a fake doorway. That first trader is now stuck in a bad position. Not because he was stupid, because he answered excitement, not evidence. Now look at the second person. Same chart, same candle, same temptation. But instead of clicking, she pulls her hand off the mouse. She looks at the yellow sticky note by her screen. 3 questions. First, where is the exit if this fails? If price falls back under the range, she's wrong. Good. That gives the trade a line in the sand before emotion shows up. Second, how much exposure is she taking? Not how much she hopes to make, how much she can lose if the move snaps back. If that number feels too big, the trade is too big. Third, is this a real setup or just a shove into obvious stops? In plain English, did price break out and hold, or did it only spike high enough to trigger everybody's panic orders before fading? That third question is the whole game here, so she waits. 10 seconds, maybe 20. At 9:42, price loses the level and falls right back into the range. That tells her something the first candle never could. The jump was not strength. It was a sweep through easy orders. The pattern is clear beginner's miss. She did not need to predict the trap. She only needed to avoid paying full price before the chart gave an answer. That's how middlemen move price in fast markets. They don't need a cartoon villain speech. If there aren't many orders sitting nearby, price can jump through thin levels. It triggers a wave of emotional decisions. Then it snaps back once that fuel is used up. One trader got dragged by the first move. The other waited for the reaction after the move. So, the big question is, what exactly are those 3 questions? And why do they take less than 10 seconds to save you from the worst click of the day? You don't need a faster mouse. You need 3 better questions. A candle rips up. Your heart jumps. It feels like the move is leaving without you. That's the exact moment most beginners click for the wrong reason. So give that moment a simple name. The 3-question market maker check. Quick aside, if this helps, subscribe for more twice a week. Question 1. Where are the obvious stop-loss levels? A preset price where you automatically get out of a losing trade. Usually they sit above yesterday's high, below a morning low, or around a clean round number like 500. Question 2. Did price move smoothly, or did it jump through thin levels? If it skips prices fast, there often wasn't much standing in the way. A middleman has a name in markets, a market maker. When there's not much available nearby, price can lurch. Question 3. What happened right after that obvious area got hit? Did price keep pushing and hold there, or did it stab through, pause for a second, and snap back by 10:07 a.m.? That last part matters most. A real move usually holds the new area. A trap usually reverses fast once the stops are spent. So before you click, run the check. Where are the stops? How did price get there? And what happened after it arrived? But there's one part beginners still misread constantly. Next time a candle, the bar showing price movement over a set time, rips into an obvious level, do one thing first. Wait 10 seconds. Watch the reaction. If price can't hold the new area, your best trade may be no trade. That tiny pause can save you from the trap beginners feed every day. If this kind of breakdown helps, subscribe. The next lesson shows why slow, boring entries often beat fast, exciting ones.